The NASDAQ is closed for the weekend, so the last reported trading price for PayPal Holdings Inc., under the ticker PYPL, was $66.22 USD as of the closing bell on Friday, November 7, 2025, which saw the stock finish with a marginal change of minus 0.040 USD, or a minus 0.060% move on the day. Now, most investors looking at that flatline close after a period of intense volatility might simply think, well, the stock is taking a breather, or perhaps the momentum from the recent earnings beat and the buzz around the OpenAI partnership is finally wearing off. That's the common expectation, a quiet settling after a storm of news. But the reality, when you look beneath the surface of that anemic daily movement, tells a much more complicated and significantly more intriguing story about a genuine struggle for the stock's soul. The real insight isn't in the price itself, but in the institutional tug-of-war playing out just below the surface, a struggle where significant players are betting on two wildly different future valuations for this giant of the payment space. What the daily close fails to capture is the massive, quiet churn in institutional positions over the last quarter. While many retail investors, especially those active on platforms like Robinhood, may have jumped in on the news of PayPal's partnership with OpenAI to integrate payments into ChatGPT, a move that certainly gives the company exposure to the future of agentic commerce, the most sophisticated institutional money is showing a divided response. Looking at the latest 13F filings, you see a striking pattern. The total number of institutional holders has actually slightly decreased, yet the total value of their long holdings remains immense. More importantly, the number of institutions increasing their positions is being narrowly outpaced by the number of institutions decreasing their positions. This isn't just passive holding, it's a deliberate exchange. For every institution, like a major pension fund, selling off a large chunk, perhaps due to a rebalancing toward more traditional value plays or macroeconomic risk aversion, there is another significant fund, often a high-growth hedge fund, either initiating a new smaller position or materially increasing their existing one, placing a bet on a very specific turnaround narrative. The general belief, particularly among those who follow fintech broadly and are perhaps also tracking movements in SoFi Invest or similar high-growth names, is that PayPal is an established, profitable, but slow-moving ship that has lost its competitive edge to newer, nimbler players like Apple Pay, the expanding capabilities of Fidelity's digital offerings, or even the sheer scale of companies like Amazon. The core challenge to this popular belief is the quality, not just the quantity, of PayPal's recent operational wins. The third quarter earnings beat, for instance, wasn't just a simple beat. It was paired with the first-ever announcement of a dividend, a major signal to the market that the company's financial profile is maturing beyond the growth-at-any-cost phase. This shift to returning capital to shareholders, along with a revised focus on high-margin branded transactions, directly challenges the narrative of a company in an irreversible decline. It suggests a management team, led by CEO Alex Chriss, that is strategically pivoting to profitability and financial discipline, moving the stock from being valued solely on user growth to being valued on its cash flow, a contrarian take that forces a serious reevaluation for long-term holders. The day-to-day market movements for PYPL in the past few weeks, oscillating between roughly the $64 and $69 range, directly reflect this tension. The volatility has been driven by earnings reactions and the interpretation of those earnings. The stock initially spiked after the report and the OpenAI news because the market's expectation was that the firm would continue to show signs of weakness. The reality of a profit beat, a raised full-year guidance, and the introduction of a dividend exceeded those low expectations dramatically. However, the subsequent pullback into the mid-$66 range highlights the deep-seated skepticism. Volume has remained robust, sometimes exceeding the 30-day volume average of around 15.5 million shares, which further points to the active institutional repositioning we discussed. When you see daily trading volume surge during a consolidation period, it's rarely just retail traders on their individual brokerage accounts. It's the big money cycling in and out. The price resistance around the $69 to $70 level indicates where a significant number of short-term traders or longer-term skeptical holders are deciding to take profits or cut losses, capping the immediate upside despite the good news. Focusing on the business model for a moment, PayPal's foundation is its massive two-sided network. Over 400 million active consumer accounts and tens of millions of merchants globally. It generates the bulk of its revenue through transaction fees, which include fees for merchant services, cross-border payments, and instant transfers on platforms like Venmo. The general public often reduces PayPal to just the checkout button, but the strategic core of the company is now increasingly focused on its unbranded processing business, Braintree, and the monetization of Venmo. Braintree is essential because it allows PayPal to capture payment volume even when the customer doesn't specifically use the branded PayPal button. The future success of PayPal hinges on its ability to drive growth in these higher margin areas and maintain its commanding presence in the e-commerce checkout space against competitors like Stripe and the aggressive payment expansion of companies like Apple stock. The current management's strategic shift is toward what they call profitable growth, a direct acknowledgement that the era of simply adding users at any cost is over. They are consolidating their technology stack, focusing on fewer but more impactful features, and leveraging their immense data advantage, especially through AI-driven solutions like the Advanced Offers platform. This is where the OpenAI partnership shines, as it is a tangible example of integrating its payment infrastructure with the cutting technology that is currently driving so much investor interest in other segments like that surrounding NVIDIA stock. This move effectively counters the argument that PayPal is a technological laggard. The successful scaling and monetization of Venmo, which is projected to surpass $2 billion in annual revenue by 2027, is another critical proof point that is often missed in the skeptical market narrative. This focus on core profitability is what appeals to value-oriented institutional investors, contrasting sharply with the impatience of high-growth funds. Looking ahead, the future outlook for PayPal Holdings, Inc. is a collection of possible scenarios tied to execution. In the most optimistic scenario, the new management team effectively streamlines operations, and the focus on branded, high-margin transactions, combined with the success of Braintree and Venmo monetization, translates into sustained double-digit non-GAAP EPS growth by 2027, as management has projected. The OpenAI partnership could expand beyond a simple checkout integration into a more deeply embedded agentic commerce solution, where AI drives purchasing decisions that automatically use PayPal for settlement. In this world, the stock price could easily track back towards the consensus analyst price targets, which are currently sitting in the mid-$80, representing a significant upside from the current level. The risks, however, are substantial and center primarily on competition and the macroeconomic environment. Increased competition from tech giants, especially if Apple decides to aggressively unleash more financial services, could continually pressure transaction margins. Furthermore, any significant deterioration in U.S. consumer spending, which PayPal CEO has already hinted at, would immediately pressure the total payment volume, the blood blub of the business. This expectation versus reality dynamic is the entire thesis for PayPal right now. The market expects an old-guard digital payment processor, slow to react and losing relevance. The reality is a deeply profitable company, one that is shifting its strategy, initiating a dividend, and using its massive cash flow for both share buybacks and targeted investments in new technology like the OpenAI collaboration, all while managing an activist investor-driven strategic overhaul. Whether you are a fan of self-investing or prefer the managed approach of Schwab Intelligent Portfolios, this dichotomy matters. The current stock price, $66.22, is a price of deep skepticism. For the stock to break out of this range and reclaim higher ground, the management team must continue to deliver not just on earnings, but on the narrative of operational efficiency and strategic focus. They need to prove that they can be a disciplined financial titan while also being agile enough to secure partnerships that position them for the next wave of commerce, which includes artificial intelligence and other high-growth sectors currently driving the valuation of companies like Tesla stock. Finally, let me ask you to engage with this for a moment and consider the biggest threat. Comment below and tell me whether you think the biggest headwind for PayPal right now is the rise of competitors like Apple Pay and similar digital wallets, or if it is the broader macroeconomic pressure on consumer spending and transaction volumes. This is an important distinction to make when evaluating the stock's forward trajectory. The decision for investors, whether they are looking at Fidelity ETFs in their Fidelity IRAs or individual shares through their Robinhood app, boils down to a belief in management's ability to execute this pivot toward higher margin, branded dominance. The story here isn't one of explosive, simple growth. It's about a complex, high-stakes turnaround effort within a mature, competitive industry. The quiet